Hello, Facebook. Welcome to 39.6 Facebook Live Show, where we talk about how to make your money work for you so you don't have to work for your money. Today's topic, this is our taxes episode number 5. This is episode number 19. We will be talking about interest. All right, Pinky is not here with us today. Ari, welcome. Thanks for coming. So I'm sorry, but we don't have Pinky. This is when she usually dances and sings a little song for us to get ready for the show. But no Pinky today. So it's been a whole week since I've done a show, actually been 8 days. I've been trying to do these more than one time per week, but the last couple of weeks have been really busy. We went to Disneyland last week. We were in LA for a few days for a big family gathering. And then on Monday we moved to a different apartment. And so we are just settling in. I am actually broadcasting from the common area of the apartment because we're not quite settled in, although we do have Wi-Fi now, so that is fantastic. Yeah, so I'm using this common space. There's like a boardroom area here. It's a little bit echoey, so I apologize for that. They have a separate room that I was going to broadcast from that had these like soundproof like cushions on the walls, except that the door is glass and outside there they have like music in the background, and it was going to be, I think, a little bit loud. But maybe I'll try that. But I'm glad we were able to at least get a show in tonight, and we are going to talk about interest. Okay, so today's topic is interest, and I am going to type this in here. Okay, so interest is actually the one thing that probably most people understand the most because they're used to paying it, okay? As an investor, you can collect interest. You can be on the other side of the coin, okay? But a lot of Americans are very used to paying interest because they have credit card debt and they're accruing interest every single month, sometimes as high as like 25% of the bill, or at least 25% annualized interest. So that could be like 2% per month of their balance keeps getting added on, okay? A lot of people have mortgages or student loans, so you're paying interest on those, okay? And so basically, when you're an investor and you loan somebody else money, you get to collect the interest. And that interest to you is income, okay? When you're investing in bonds, that is effectively exactly what you are doing, okay? Or even if you just have your money in a high yield savings account or as a checking account or a regular savings account or a CD, okay? So let's kind of take these in order. So a checking account pays you interest of usually 0.01% per year. So if you have like $100 in your checking account as an average balance over the course of 1 year, 1% of that would be $1. So 0.01% of that would be 1 cent. Okay, so you would receive 1 cent for every $100 of average balance. Okay, so it's not very much money. Okay, if you have your money in a savings account, a regular savings account might pay like 0.5% interest. Okay, so you have $100 in there, and instead of receiving 1 cent per year of interest, you would receive 50 cents. Okay, now if you get a higher yield savings account, for example, some of them are paying 2 or 3% interest. Usually the ones that are like 3% interest, that's for a limited amount of money, like $10,000 or $15,000 of a balance. But let's pretend that you have a $10,000 balance that you can get 3% interest on a checking account. Well, 3% of $10,000 would be $300 per year, okay? Or if you had $10,000 sitting in there and they pay you interest every month, it would be $25 per month, okay? So that is interest on a savings account. Now, if you have a CD, called a certificate of deposit, it also pays you a fixed rate of interest. Okay, and a CD means you have to basically hold your money in there for a certain amount of time in order to get that interest. like a 6-month CD will give you a certain rate of interest. A 2-year, 3-year, 5-year CD, the longer the CD is, the longer it is held, the more interest you receive, okay? Now, those accounts which I just mentioned, checking, savings, like a high yield savings or a CD, those are all FDIC insured, and that means that basically you can't lose money on them, okay? If the bank for some reason loses your money, there's insurance to replace the money that you lost, okay? Now that's interest. Now, on a different category of investments are things that have a little bit of risk of losing principal or losing value, okay? And that would be anything where you're basically loaning money to somebody, okay? So bonds, okay? And I was alluding to that before, okay? If you have a money market account, that is like a savings account, but it is a little bit different. They're not FDIC insured, okay? Money market accounts, they basically, whoever you have it with, they are doing very short-term loans, often like 30-day loans, and so they can get a little bit higher interest rate potentially than a savings account, but it just depends, okay? Like all of our extra cash, when we're just piling cash up for another investment, we keep it in a money market account. We keep ours in a municipal money market account, and we're gonna get to that in a little bit, okay? Or you could do things like short-term bonds, intermediate-term bonds, long-term bonds. The longer the term, the higher the interest yield tends to be, but also you have other risks associated with that. And I'm not gonna go into that at length today, but we're gonna talk about the return you get and how it is taxed in particular, okay? So the interest you receive for leaving money of yours with the bank or for loaning it out to the government in like a US Treasury bond, when you receive that money, the interest, that money is given to you and it is considered ordinary income, okay? So it is counted on your taxes as basically earning any other dollar that you would have earned for your job, okay? However, you don't pay Social Security on it, you don't pay Medicare on it because it's not income tax. You're not getting it from a job, but you're getting it from an investment. However, when you're getting money from an investment, they also have the additional tax we talked about in the previous 2 episodes called the net investment income tax, the NIIT. That only affects people with an adjusted gross income of $200,000 if you're single or $250,000 if you are married. But that extra tax is 3.8%, okay? Now, the regular tax brackets, okay, there's actually 7 of them, okay? That's 7 right there. Now, in the previous 2 episodes, I had talked about capital gains and dividends. And remember, long-term capital gains and qualified dividends are subject to lower tax rates. They just have those lower brackets of 0, 15, and 20. But again, that NIIT makes this actually 0, 15, 18.8, and 23.8. Okay, now for ordinary income, which would be like short-term capital gains or non-qualified dividends or interest from like a government bond or savings account, those are all taxed at the 7 tax brackets, but remember the NIIT will come in. Okay, now I actually haven't really gone through the 7 brackets because it's so tedious, but it's 0%, 10%, 12%, 22%, 24%, 32, 35, and 37. So it's 8 brackets if you include the 0% bracket, okay? But once you get over that $200,000 or $250,000 hump, okay, and that happens when you're at the 24% bracket, you'll get an additional tax bracket here. So it ends up being 24% or 27.8%, which is that extra 3.8. And then all the additional brackets after that will have 3.8 on top of it. So there is no 32% bracket. It ends up being 35.8. There's no 35% bracket, it's 38.8. And there's no 37% bracket, it's 40.8. Okay, so you end up with like 9 tax brackets for ordinary income, okay, which is your income from your job, it's for non-qualified dividends, it's for short-term capital gains, or any interest that you receive from your savings, checking accounts, or regular bonds, okay? Now, there is a big exception to this, and this is where things can get complicated. There's a different category of bonds that are called municipal bonds. Okay, so a municipality is a government entity. Okay, so for example, if you live in the city of Chicago, Chicago is a municipality, and Chicago collects its own city taxes. Okay, and that pays for the police and rescue squads and education for that city. Okay. Now, a municipality often needs to raise money to do things, okay? So, for example, in our little school district area, city, sub-city that we kind of live in, there was a ballot a couple years ago to have a bond for the schools. They wanted to take the 4 elementary schools, renovate all 4 of them, and add a 5th one. This was going to cost a lot of money. I don't remember how much money it was, but it was a lot of money. And people had to vote on whether or not to pass the bond. And it passed barely, like 52% to 48%, which is a whole ordeal. But a lot of people just didn't want to pay extra tax, okay? And they made all these crazy arguments not to do it that had nothing to do with the schools and scare tactics. But frankly, when a city needs to have a bolus of cash in order to do something, well, they don't just like borrow money from the bank, okay? They may get a loan somehow, but they raise capital. And this is a routine way for a city to get money is to sell bonds, okay? So they pass the proposal and they said, we're going to raise, let's say $100 million. It was way more than that, but let's say $100 million in bonds. And so that basically meant that the city was going to have to sell off these bonds at an interest rate that investors would want to buy them. Okay, so you can buy these bonds and they will offer an interest rate like, let's pretend 7%. Okay, so if they're selling these bonds, and let's pretend I want to invest in that and I want to buy a $10,000 bond. Okay, so that $10,000 I give them, I get a bond, and then they're going to pay me 7% every year on that bond. So $700. Okay, now they have to pay that money back to me, and where is that money ultimately going to come from? It's going to come from taxes. And so the municipality sells the bonds, and then they have to generate the revenue to pay off that debt. Okay, and that comes from tax. So a lot of cities, municipalities, when they need to raise this money, they will have an interest rate on the bond, and it will get graded based on whoever's grading it as to how secure it is, how likely they are to pay it back. Now, the higher the interest rate, the higher the risk is of that bond. Now, because the cities, they need the money and it's going to help people in the city, the IRS basically gives them a break. Okay, so they let the municipalities raise money such that the interest they pay out to the investor does not get taxed in that location. Okay, and so for example, let's pretend you live in Chicago, and I don't know the tax rate in Chicago, but let's pretend the tax rate in Chicago is 10%. Okay, for living in Chicago. Well, the money that you earn on that bond would not be subject to paying taxes in Chicago. Often it doesn't. You wouldn't have to pay federal tax or state tax. So sometimes when you're buying municipality bonds, that's what they call triple tax advantaged, and we use that term for HSAs also. But you could get away from paying state tax, federal tax, and local tax. Okay, and because you're avoiding all those tax, well, they just don't give you as high of an interest rate. So instead of giving you 7%, they may make the bond just 4%, but you don't have to pay any tax on it. Okay, so municipal bonds are tax-free, and there are different categories of municipal bonds, and they can get very, very, very confusing because states have all their own different rules, cities all have their own different rules, counties, I mean, there's all sorts of different layers of taxation, okay? But there are municipal bonds that are, for example, federal municipal bonds, okay? Where you can invest in those and you don't have to pay federal tax. You may still have to pay state tax on it or city tax if you have to pay those, okay? Money market accounts can be municipal money market accounts, okay? So our money market account is a municipal money market account. It pays about 1% interest. However, that 1% interest is not subject to any federal tax, okay? So whenever you're putting money into a bond, you need to decide what that rate is you're getting, and if you would do better with a municipal bond and vice versa, assuming the risks are the same, okay? Now, any municipal bond that's limited to like a small local area, you're putting your money at risk to that small area, so it's not very diversified. But if you have large federal bonds that are municipal bonds, then you have a much bigger area, so you have less concentration risk, okay? But those local municipal bonds can have that triple advantage, or state municipal bonds could have a double advantage, state tax-free and federal tax-free, okay? So our government municipal, or sorry, our federal municipal money market account that we use from Vanguard is about 1% interest, okay, but it's tax-free. Okay, so let's pretend we have $100,000 sitting in cash on average in that account, for example. We would generate $1,000 of interest over the year. That $1,000 of interest, no tax, okay? If I, for example, decided to put into the regular federal money market account that is not a municipal money market account, and let's pretend it's paying 2%, well, then I would generate $2,000 of interest. Sorry, $2,000 of interest on my $100,000. But that $2,000, I would get a 1099 INT, sorry, in January. And that 1099 INT would say you earn $2,000 of interest that you need to report on your 1040 when you file your taxes. So then you're paying tax on it. That will get taxed at my marginal tax rate, the highest bracket I'm getting taxed at for the year. And if I'm above that 200K or 250K threshold, I'll also pay the additional 3.8% NIIT, net investment income tax. So if I'm at the top tax bracket this year, that's 37%, add 3.8%, I'd be paying 40.8% on it. Okay, so that $2,000 of interest, I'd be paying 40.8%. That would be $801.60, I think. Okay, so let's just say $800, make life simpler. My $2,000 of interest, I'd have to pay $800 in taxes. I would net $1,200. Okay, now on the other hand, if I just invested in the municipal money market account, and I get $1,000 of interest, but I don't pay taxes on it, well, then you have a difference of the $1,000 versus $1,200 net. So I would still come out ahead with that $200 extra if I was getting 2% on the federal money market account. Now, these rates are constantly changing, and some days it's possible that the money market with the municipal money market might give me a better net yield than the federal money market, okay? And it also depends on your tax bracket. If you're only in a 10% tax bracket, well, the federal money market account definitely would give you much better. And I'm just making up the numbers, the 1 and the 2% to make it easier. I don't know exactly what they are today, but the point is they are different and you need to adjust them for taxes. I see so many people talking about, oh, where do you put your emergency fund? This one is at 1.79%, and this one's at 1.92%, and this one's 2%. Like, okay, these are tiny, tiny, tiny portions of a percentage, for your emergency fund, which is whatever, maybe $50,000, and you're going to quibble about 0.2% difference on $50,000, that's $100, okay? And that $100 is going to be subject to tax. So if you're at the highest bracket, you're paying 40% on that. Your $100 is now a $60 difference. And those interest rates between different banks, they're constantly changing. One bank goes up, one bank doesn't. So now people start moving their money over here. It's just a silly game that banks play to try to attract people who are coaxed into differences of 0.1%, when in reality, it has almost no effect whatsoever on your wealth. So we try to keep things a little bit simpler and try to keep things at one place as much as possible and not move our money around from one savings account to another. Good enough interest rate is a good enough interest rate on our cash. We make way more on all of our investments, and that's where the return really is. It's not worth the brain power, the stress, the paperwork, getting all these extra tax forms from having money scattered in different savings accounts. Some people try to get their full 3% on $10,000 balance at one place, and then another $10,000 at another place at 3%, and then make another one for their kid at 3%. Like, it's just, there's so many better ways in this world to make money than trying to maximize every single savings account, okay? So, in summary, you have interest, which is paid to you whenever you loan money out or keep your money at an institution, and they're basically making money off of you. Okay, if you make more than $10 in interest from anything, you're going to get a 1099 int if it's taxable. Okay, if you have municipal bonds or municipal money market account, it is not taxable at the federal level. Okay, so that is tax-free, but you'll get a lower yield. If you invest in state municipal bonds, you're likely going to get a state tax deduction and a federal tax deduction. If you do local bonds, local municipalities, you could have a local tax deduction or a locally tax-free, state tax-free, and federal tax-free potentially. But whenever you use a smaller and smaller and smaller area that you're investing your money with, you have more concentration risk. And so you might not want to put all of your money in just to one location, because if they default, all of that is defaulted. When you're paying ordinary income on your bonds in any taxable account you have, that will be at your highest bracket for the year plus a 3.8% if you make over 200 or 250K. So think strategically about where you keep bonds, and if it's in a taxable account, choose if you want to do municipal bonds or not. They have different risks associated with different types of bonds, and really just kind of focusing on the taxation aspect of it today. Okay, so that concludes basically the series on taxes on the basic things. Social Security, Medicare, federal progressive tax, capital gains, dividends, and interest. Those are the 8 main things. There are all sorts of other things we can talk about with tax. I should probably give a good example of a regular federal tax with all of the 8 or 9 tax brackets, and I will probably do that. But really just need to get all the concepts down so that whenever I refer to them, you have a place to go refer and see the original information. All right. Thank you guys for coming. Ari, hello. Anar, Kate, thank you. Bantu, thank you. Roman, and Vivian. Nice to see you here. Vivian Romero-Dean. All right. I will, if there are any questions, feel free to shoot them out. Otherwise, we're going to wrap it up for today. This is episode number 19. And until next time, think about what you can do to have your money work for you so you do not have to work for your money. Take it away, Pinky. Imagine she's here and that she's singing and dancing. Until next time.